In this video, we're going to discuss the Sarbanes Oxley Act, which is sometimes referred to as SOX. So SOX was passed by U.S. Congress in 2002, and it was passed in response to a wave of accounting frauds from companies like WorldCom, Enron, Global Crossing, Tyco. There was this wave of accounting frauds, and we even had one of the 5 largest accounting firms, Arthur Andersen, was caught up in all this. They were destroying documents, they were charged criminally, and they ended up going out of business as a result of all of this. And so Sarbanes-Oxley it did a number of things. First of all, it had new rules for publicly traded companies and their executives, but it also created a lot of new rules for audit firms, and it also resulted in the creation of the PCAOB. So I want to talk about each of these in turn because there's a lot going on here. So first of all, in terms of the rules for companies, the CEO and CFO of a company, or their principal officers, which is usually the CEO and the CFO, must sign off and certify the veracity of the financial statements. Now, you might think that this was obvious, and of course, well, didn't this happen before? Shouldn't the CEO stand by the financial statements of their firm? But the thing was, when there was that wave of accounting frauds, you had CEOs saying, hey, look, I'm not an accountant. I don't know what's going on here. I didn't actually put together the financial statements. I'm just kind of managing the company. And so Sarbanes-Oxley made it very clear that the CEO, the CFO, they have to sign off on the financial statements. And if there's some kind of problem, they're subject to criminal penalties, particularly if later they're found to be destroying documents, and this even applies to the audit firm, in particular the audit firm, if they're destroying documents or something like that, they can be subject to stiff criminal penalties. So also, the company now has to assess the effectiveness of its internal controls. So internal controls, I'll make another video. We'll talk a lot about internal controls and auditing, but internal controls are basically things that are in place in the firm to prevent fraud from happening, to prevent different things to kind of mess up the financial reporting process. And so a company has to set up these controls to make sure that we don't have an accounting fraud to begin with, right? So they have to not only have these internal controls in place, but companies have to go and actually assess the effectiveness, and then they have to issue a report on the effectiveness. So if they do the assessment, they find out there's some kind of problem, a material weakness, some kind of issue, they have to actually report on that. Now, the audit firms, they have just as many changes, if not more, as a result of Sarbanes-Oxley. First off, they have to implement quality control. If they have a publicly traded client, they're going to be subject to a lot more oversight. We're going to talk about that. But first things first, they have to have a second partner on any audit of a publicly traded client. They have to have a second partner review and approve all of the audit reports, right? So you've got one partner who's like the lead partner on an audit, right? So let's say there's an audit of Walmart or something like that. There's an accounting firm that's auditing them. There's a lead partner on that audit engagement, but there's a second partner, a reviewing partner, who has to come in and kind of sign off and check on everything that has been done. Now, the lead partner and the reviewing partner, they have to rotate out every 5 years. What it means by rotating out is let's say that Paul's the lead partner on the Walmart audit, and Paul can do that for 5 years. But after 5 years, Paul cannot be the lead partner on the Walmart audit anymore. He could obviously stay with his accounting firm and so forth. He could do all that. He doesn't have to leave his company or something ridiculous. He could stay with a CPA firm. He just can't audit that particular client any longer, right? He can only do it for 5 years. And the idea behind this is we don't want Paul to get too cozy with the management of Walmart, because if Paul has been handling this audit for 20 years or 10 years, then Paul, he becomes maybe friends with the people and so forth at the client, or there's pressure that he doesn't want to do something that will somehow cost his firm that client. So every 5 years, Paul or whoever is the lead partner, we're going to switch to somebody else. The firm has to put somebody else, right? So it's the same accounting firm. It's just they switch out to a different lead partner, different reviewing partner. That's basically what's happening. Okay. Now, in addition, where we had talked about how management of the firm, so let's say Walmart, has to assess the effectiveness of their internal controls and issue a report, the audit firm also has to do that. not of itself, but of the client. Okay, so you've got the client, let's say Walmart, they're assessing their internal controls and issuing a report, but then the audit firm is going to assess Walmart's internal controls and issue a report on Walmart's internal controls. So there's two reports that are happening here. Now, this is, in terms of the complaints about Sarbanes-Oxley by firms, this is the part of Sarbanes-Oxley that's been criticized probably the most. It's called Section 404. And the reason is that a lot of people complain that it's very costly for the firm to have to go and assess its internal controls, issue a report on that, and then now they're paying the audit firm more because the audit firm now has to do more work, right? They're not just going to do that for free. They're going to want more money. So the audit firm is actually getting more business if you think about it. And so there's actually a lot of accountants got hired because this Section 404 compliance creates a lot more work for the accountants, but and so it's been a boon for them. But for the companies, they have to comply with these internal control disclosure requirements. But all of this was done, again, to try and prevent from happening again where we have a wave of accounting frauds and people say, hey, can we even trust the financial statements of firms and so forth? So that's the intention. And then also another really key component to Sarbanes-Oxley is that an audit firm is now prohibited or prevented from providing a lot of non-audit services to the audit clients. And what do I mean by non-audit services? So if you don't know a lot about audit firms don't just audit financial statements. That's not the only thing they do. They also provide advisory services. And if you think about it, if an auditor, they're getting to look at the internal books of a company, right? So as they do that, they can learn a lot about how to better do business, and they might have suggestions about how the company can improve its business operations and so forth. So it stands to reason that you might have the auditor say, hey, client, we could really help you optimize your business processes. We could help you do this and so forth. And that actually happened. And so what you had, though, was it turned into a problem. And the reason was that in some cases, you had a firm auditing a client, and actually the amount of money that the audit firm was getting for these non-audit services was actually higher than the audit fees they were getting. Right, so if a company, just think about it. If you're an audit firm and you're getting $10 million for consulting, you're getting these consulting fees from the client, and then you're maybe getting $1 million for the audit fee, and you say, hey, I don't know if their financial statements are completely legit. There could be some problems here. You don't want to say, hey, I don't want to sign off on this audit because I don't know about this firm's financial accounting practices, because you're going to lose not just the $1 million, you're going to lose the $10 million for consulting. So there's a lot of pressure on these auditors to kind of look the other way or say, you know what, hey, we're getting a lot of business from this client. We don't want to lose them by creating problems with the audit. And so now they're prevented from doing non-audit services, not just in general. I mean, so you've got your client, and then you've got some other company that's not your audit client. So we'll say non-client. So you could provide. So you do an audit for a client. You're just prohibited from doing the non-auditing or non-audit services for the client. Okay, so let's say Walmart, but then let's say there's another company called Monsanto that you are not doing their audit, so they're a non-client. Then you can provide whatever services to the non-client. It's just when you're actually you're doing the audit of this audit client, right? So you're doing their audit, you can't turn around and do non-audit services such as investment banking, consulting, valuation services. You can't be their internal auditor. You can't be designing their financial information system. So there's a bunch of non-audit services you can't provide to an audit client. Now, one of the really lasting effects of Sarbanes-Oxley that's tremendously as important is, aside from all the rules for the companies and CEOs and the audit firms, it created something called the Public Company Accounting Oversight Board, which is commonly called just the PCAOB. So the PCAOB does a number of things, right? So, but first off, before I even get into that, before we had the PCAOB, basically the audit industry, when you think about audit firms, they were self-regulated. To a large extent, they were self-regulated. And so with the PCAOB, that ended. Basically, now the PCAOB, you could think of them as the watchdog for auditors. So now, if an auditor, if they have at least one publicly traded client, they have to register with the PCAOB, and then the PCAOB will monitor them, and every now and then the PCAOB will actually go and look at a sample of their audits and kind of evaluate and see are they doing a good job. The PCAOB also handles standard setting for the auditing industry, and they also handle enforcement when there's some kind of a problem, the audit firm isn't doing things right. And we'll talk more about the PCAOB in a video to come.